Today, how to jump-start SMEs. Hello again, it's Martin North from Digital Finance Analytics, with the latest post covering finance and problem news with a distinctively Australian flavour. The government has a bill on inquiry in the Senate, Australian Business Growth Fund Bill 2019 provisions. In fact, on the 6th of February 2020, the Senate referred the provisions of the Australian Business Growth Fund Bill 2019 to the Economics Legislation Committee for inquiry and report by the 21st of February 2020. The bill is positioned as a way to assist small and medium businesses to obtain financial backing and acknowledges that many SMEs are facing significant funding issues. So the bill proposes a formation of a standalone investment fund which will invest between $5 million to $15 million in small and medium enterprises that have a turnover between $2 million and $100 million, where they can demonstrate 3 years of revenue growth and a clear vision to expand. And it's worth noting in passing that this proposal is very much based on a concept that was developed in the UK. The government and 5 of our largest banks will put up on average $100 million into the fund. And established Australian businesses will be eligible to apply for equity capital investments between $5 million and $15 million. Small business owners will not have to give up control for this investment. The Business Growth Fund's investment stake will range from 10% to 40%, setting a balance between business owners keeping control of their businesses and providing enough incentives for investors. Initially, the Business Growth Fund could support 10 investments per year, with the aim to increase to 30 per year as the fund develops. And banks and superannuation contributions could enable the fund to grow to $500 million. So that's their proposal. And I have made a submission in response. In fact, I was asked to by the Senate inquiry. So I want to make 3 points. The first is that SMEs are indeed an essential part of our economy. The small and medium business sector is a critical growth engine for the economy, with more than 3 million businesses offering employment to more than 7 million Australians. But the characteristics of these businesses are varied, from newly founded part-time entities through to businesses employing up to 100 people and with a turnover of up to 10 million or more each year. But more than 77% have a turnover of less than 500,000 each year, and 91.3% have an annual turnover of less than $2 million each year. So one size does not fit all. The largest industry segments is construction at 17%, followed by professional, scientific and technical at 12.5%, then rental, hiring and real estate services at 11.5%, financial services at 9% and agribusiness at 8.25%. Note that mining only accounts for 0.4% of all SMEs. Nearly half of all businesses have been trading for less than 4 years. And cash-trapped sole traders are most likely to fail at 55% in 5 years, followed by cash-strapped sole traders and stable subcontractors. The highest failure rates are found in transport, financial services, real estate and construction. And most SMEs are true small businesses, and 1/4 of SMEs have a sales turnover of less than $50,000 each year, and more than half have a turnover of less than $150,000 per annum. Most low turnover businesses are unincorporated, while those businesses with larger turnovers are more likely to be formed as a company. Looking at the distribution, 60% of businesses are in New South Wales and Victoria. Now, all of that data comes from the DFA SME surveys, which are run on a continuous basis, and we have 52,000 in our segmentation at any one time, and we segment businesses based on a range of parameters from very small businesses to very large, and based also on their life cycle. Now, the second point I want to make is that funding is indeed a growing problem for SMEs, and that comes very clearly through in our surveys. We've detected an increased problem with more businesses unable to obtain suitable finance to enable them to grow and invest in their businesses. Underlying this is the fact that demand from households and businesses for services from the SME sector is waning as the broader economy falters. SMEs are indeed the canary in the economic coal mine. For many segments, the need for working capital is the main issue, and the main cause of this need relates to delayed payments. This is particularly a concern among some smaller businesses. The average debtor days is still elevated, with 45% of firms reporting an average settlement time from invoicing of 50 to 60 days. There were minor variations across the states. Debts from large corporates and government entities are both taking longer to settle due to enhanced cash flow management techniques. The average number of banking relationships varies across the segments. Larger and more complex businesses are likely to spread their relationships. Others in need of funding will also try to access facilities from many sources and so have more complex relationships. Satisfaction with banking services remains in the doldrums, with around half of all businesses dissatisfied or very dissatisfied with their bank and only 17% very satisfied. The satisfaction rating did vary by segment, with more established firms who do not need to borrow the more satisfied, while newer, smaller firms seeking to borrow the least satisfied. For them, access to credit was a significant issue. Compliance and price were the two most significant causes of dissatisfaction, though only 5% said obtaining funding was the root cause of their concerns. When asked about their propensity to switch lenders, 61% said they would consider moving. However, when we examine their length of time with existing banking relationships, many are rusted on long term. The inertia and the gap between intent to switch and switching is explained by a combination of time constraints, complexity of switching, and the lack of available alternatives. Again, this footprint varies by segment. We continue to see the rise of fintech lenders operating in Australia, with around 23% of SMEs having applied and a further 10% saying that they will apply for funding in the future. Overall awareness is rising, although there are some concerns about the true costs of borrowing from this source. Many lenders are reluctant to lend to the sector. They require security mortgage over property, for example, and funding is expensive. Banks prefer to lend to households as opposed to businesses, partly because of the relative capital ratio costs and lower risk profiles. So some businesses are turning to the growing fintech sector, where unsecured finance is available at a price, but getting funding through these channels can be expensive because of the lack of true competition and high demand. And my third point is, we agree with the proposition that Australia currently lacks a patient capital market for small and medium enterprise, but this is not the main issue blocking the growth of the sector. Access to straightforward credit is the problem. But the proposed bill is targeting the wrong SME segments. We understand the fund will invest between $5 and $15 million in small and medium enterprises that have a turnover of between $2 million and $100 million. Now, our research indicates that this particular segment is small. They can already obtain funding from such expansion. Many would fit within our business in transition segment. And as a result, we do not believe many would be prepared to give up such a large stake in their growing businesses. It seems this proposal is more orientated to offer investors and the financial sector a return than being shaped best to provide support for those small businesses which need assistance the most. The small number of transactions envisaged will also not assist many businesses, and the target is clearly not the bulk of those with real funding needs. Thus, we cannot support the current proposal, which we also note is imprecise in terms of assessment processes, return hurdles, and other matters. Our view is that the current proposal appears rushed and too high level, but our main point is it is targeting the wrong SMEs. We think there is a better option. We believe there is a better option to assist SMEs in their growth agenda. The truth is there is a dearth of financing available from existing major players. Their risk and capital ratios mean they prefer to lend to households for mortgage purposes than to small businesses. As interest rates fall, this pressure is being exacerbated. We think a better model will be to provide funding via the emerging fintech sector, by either providing funding which would flow to existing fintechs or by creating a new government-backed marketplace where fintechs and SMEs can transact. There are good examples of such models. For example, in the UK, the main contenders are Tide, which focus solely on SMEs, small or medium-sized companies, and Starling, which has retail accounts as well. In France, the big player is Quanto. In Germany, there's Penta and Hufsai, which is based in Denmark. In Norway, Aprilla, for micro-businesses of 1 to 10 people. And then there's Holvi in Finland, Coconut, Anna, and Counting Up in the UK, and Shine in France. And Tide now claims over 1.4% of the UK's SMEs as clients, up from 1% in December 2018, and is gunning for an 8% market share by 2023, aided by a £60 million UK government grant. Meanwhile, Starling has 46,000 SME members, up from 30,000 in March, with £100 million from the same government grant to develop its business banking offering. Quanto in France has grown from 15,000 small business customers to 40,000 in the past year and is expanding into Germany, Spain and Italy. And this year, Finnish startup Holvi, which was bought by Spanish bank BBVA in 2016, claims 150,000 customers and is expanding into France, Italy, the Netherlands, Ireland and Belgium. There's a lot of space for growth because the European market, which has around 24.5 million SMEs, is still extremely dominated by the big four lenders. In the UK, for example, 4 big banks have a 90% share of SME banking. And so this was an intentional strategy from the UK government to disrupt the inadequate SME sector, and in response, the incumbents have been forced to respond and are now upping their game and starting their own digital-focused business banks as well to compete. In November 2018, NatWest launched Metal. Santander's startup small business bank, Asto, also launched in the UK in 2008. Meanwhile, HSBC is also building its own business bank startup, known internally as Project Iceberg. The cost of funding to SMEs has dropped as the fintech sector has developed, supported by the core injection of UK government funding. These digital plays cover a wide range of services which SMEs need, as well as basic payments, transactions and lending, and they are tending to create a marketplace where businesses and service providers and lenders can interact. This is, frankly, transformational. And the SME experience has been significant, with easier access to funding, faster decisions, and the resultant rebalancing of the industry has lifted mainstream lenders too. So we think if a similar model was replicated here, the SME sector would win and Australia would win. So to conclude, the point to make is that rather than a thin deal flow targeting larger SMEs which really do not need assistance, a revised strategy could facilitate the transformation of finance to the SME sector. Thus, the planned investment could be made by the Australian government, but leading to more productive outcomes. If we were to replicate a UK model, we think it should be the current in-flight fintech-based approach, rather than one which favours incumbents and which does not deal with the core issues facing Australian SMEs. Thus, we recommended that the current proposed bill is withdrawn and the strategy redeveloped to take account of the emerging fintech scene. And in closing, I just want to underscore that this seems to be another idea that is very much shaped around supporting our existing financial system, the big 4 or 5 banks involved in this support for the SME sector, rather than taking a more objective and independent view of how to support the broader SME sector. So I fear that this whole proposition has been built from the wrong end of the plank, as it were. So once again, the government's track record is support the big end of town, never mind the small guys. Well, nothing new there, I guess. And finally, Just before I go, a quick reminder that tomorrow, Tuesday, we'll be running our next live stream event at 8 p.m. Sydney time. You're welcome to join us live on the stream and ask a question, or if you want to send a question through beforehand, you can do so via the DFA blog. The links to both are in the comments below. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.